All right, let's get started here. Welcome to our webinar. Uh, so grateful to have you here and joining us. And it's something that, really this time of year as we run into the election, it's, getting a little bit emotional for some people. And, some people are just glad to have it over. But that's what we're here to talk about today is we've been doing this webinar. We actually did the first series, part one back in the summer. And one of the things that we decided to do, because before that, it was going to be Biden versus Trump. Obviously, Biden dropped out, and so there are a lot more unknowns. And we kind of wanted to start talking about those things of what's changing, what's not changing, but more importantly, what's the data set. I just did this webinar. We've done it quite a few times over the last couple of weeks, and I did one for financial advisors about 2 weeks ago, and we did a feedback form, and it was interesting some of the stuff that we heard back. The first one said, "Hey, thanks for the 60-minute Kamala Harris commercial." I don't remember mentioning her name too often, but obviously that person thought that I was tilted a little bit too far for Vice President Harris. But then somebody else said that I may have well been wearing a MAGA hat. So same presentation. Two different people saw two different things. So it really starts from the perspective they were coming from. Obviously, we're all like that. Is we hear things differently based on what our preconceived notions are. That's just how it is, and I will accept that. Again, I don't think I was endorsing everything that Donald Trump did, and I definitely wasn't endorsing everything Kamala Harris did. But that's just how people saw it. Somebody else said, "Why is this the only place I'm seeing the data?" Appreciate that. I think one thing is that's all SEM cares about is the data, and we like to look at things differently and let you make your own decision. Um, and then somebody else that says this was the definition of fake news, and that I don't like that term. It gets thrown around. I understand why it was born, but we just take the data. When something goes different than how I think it should have, I go and look for other data sources, and I say, well, maybe I'm wrong. Maybe this data is wrong. And that's just what we're trying to provide. And when something comes up that I said, that's not what I heard, I go to independent sources and I try to figure it out. And I wish that's what everybody did. Um, and then the last comment we heard was, I couldn't tell which candidate Jeff endorsed. First of all, I'm not endorsing anybody. That's just not what we're here to do. We are here to provide you data. Please vote. That's number one. I don't care who you vote for, but please vote. I've said since the 26 years that I've been doing this that we get the government that we deserve. And what I mean by that is if we want to be illiterate, not understand math, if we only want to get our news from TikTok or Facebook or one network or the other, that's on us, because you're not thinking for yourself and you're not getting the whole story. So us as Americans overall being lazy, voting based on yard signs or the letter behind somebody's name on the ballot, means this is what we've got. We've got a very divided country full of, to be honest, a lot of people who have no idea how the economy works. If you ever want to just be frustrated, watch the congressional hearings from both sides try to act like they know what how the economy works, and it's just untrue. But then they get on their preferred news media and they keep spreading those things to the point that those people listening believe that that's what's happening. So I'm not here to endorse anybody. I'm here to educate you and let you decide for yourself. The other thing I do with all these webinars is I say, let's understand that we are humans, and what makes us different from animals is that we have emotions, we have souls, we have, our brains are so much more sophisticated than any other animal, that we will have emotions. And our daughter Courtney put this together for us, talking about the different types of emotions that psychologists have identified that we go through. Now, some people have a much bigger roller coaster and other people have a smaller one, but everybody has some sort of emotions. When it comes to investing, and this becomes important when you look at your own personal emotions, is the stock market is just a story of cycles of human behavior that's responsible for overreactions in both directions. And what we mean by that is we will get leaning one way, and based on how we feel, we're going to get overly optimistic. And then at some point we'll become overly pessimistic. And that's what we've seen over and over again when it comes to things. So little bit of a backstory or recap, if you will, for those of you who were with us over the summer for part one of this, is when we look at the economy mathematically, when I say GDP, that's the economy. I use those terms interchangeably. There's only two ways you can grow your economy. And the formula for that is how many people are working plus what are they producing. It's really simple. What's your working population and what are they generating? That's it. That's the only way the economy can grow. That's your potential growth rate. So when I look at policies, I ask myself, does this seem to put more people to work and or make them more productive? If so, that's an investment because we're growing our economy long term. If it is, say, I'm not even going to name a policy because I'll offend some people, but if it's something that's not helping more people work or helping them produce more, it's wasteful spending. That's just how the economy works. The other thing we have to understand with the economy is it's made up of different components. The first is consumer spending. Also, we see investment spending, government spending, and then finally net exports, which means what's the difference between how much we're sending out and getting money for versus how much goods we're bringing in and sending money out. So net exports, if it's a trade deficit, that's actually a negative number, so we would subtract that from GDP. When you look at our economy overall, going back to the 1940s, you could see we're pretty much a consumer-driven economy. You can see when you look at the chart here, we've seen consumer spending become more and more of the government. You could see after 1955, the percentage of government spending that represents our whole economy has shrunk. The dollar amounts, of course, are going up, but keep in mind our population is going up. So as long as our population is growing, you would expect the dollars spent by the government to grow. So even though we've had a bunch of different candidates who said, I'm going to shrink government, they have as far as a percentage of GDP, but the dollar amount being spent continues to grow. And we have a couple other lines. I think encouragingly, investments is now higher than government spending. That's a net positive because investment spending should be in things that help us grow our economy. We'll talk about that later. And we'll zero in on the net exports number here in a little bit. Overall, when you look at it, consumers are about 70% of the economy. You have the investment 19, government 17, and then you have imports are subtracting 16% while exports are 11. So that trade deficit is subtracting about 5% from GDP long term. The other thing I want to focus on is the GDP reports you always see in the media. Last one was talking about 3.2% growth. When they say that, they're taking how the economy did the last 3 months and essentially multiplying that times 4 to compound it. That doesn't really give you a good picture because if the last quarter was really, really strong or really, really weak, it's going to look much worse than it is. What I like to do and what most economists like to do is say, well, how are we today versus a year ago? Right now, coincidentally, we are about 3.2% higher than we were a year ago. The other line on this chart that you have to see is that we are slightly downward sloping long term. So our economic growth rate is shrinking. The other thing you'll notice if you look at this blue line is we historically, going back to the post-financial crisis years of President Obama, there's twice in President Obama, once during President Trump, and then this weird COVID period, we failed to get above the 3.1% average. The other thing I want to talk about is recessions. Back in 2022, everyone was saying, look, the government's changed the definition of recession. They haven't. A recession is a contraction in our economy, usually measured by 2 or more quarters of negative GDP. But it also talks a lot about the historical definition in the textbooks is, well, what's happened to employment? What's happened to output? Employment didn't go down. Output didn't go down. GDP, just because of some weird math, had a negative quarter. Actually, when they revised it, they found that the next one was slightly positive. I'm no conspiracy theorist. The data just said we didn't have a recession. But what I'm going to do throughout today's presentation is let's take a look at pre-COVID President Trump, because I think it's only fair to say, what was President Trump's performance before COVID hit? Obviously, no matter what your opinion is on that, that completely changed our economy. So it's not really fair to evaluate the performance of the economy based on what happened during COVID. In the same way, post-COVID President Biden, we need to find a way to normalize that and say, well, when is the COVID impact done, and when did we start kind of getting back to normal? When did the economy reopen? When did those comparisons drop off? So we can say, well, how are we doing today versus how are we doing just before COVID? And when you look at it overall, these two periods are almost the same GDP growth. And you could see that today. The 1 year growth rate is about 3.2%. Just before COVID, we were right at 3.2%. So pre-COVID Trump, post-COVID Biden, we're the same, at least as far as the numbers go, as far as the economic output goes. Last time I went through a bunch of different leading economic indicators. We're not going to do that. We're going to just zero in on a couple of them inside of each of these categories, because these are the things that drive our economy and things that we watch at SEM to give us that interpretation. The first is the number of jobs out there. Non-farm payroll growth is the official term. Each of these bars represents the change in the monthly number of jobs. And what you'll see, pre-COVID President Trump had some very decent time periods. The red line's the 12-month moving average, and you could see the blue line is where we're at today, and you can kind of see there weren't a lot of times where President Trump had more job growth than we have today. Not saying that's bad. He had some nice steady growth throughout. Post-COVID Biden obviously had a lot of big surges there as we kind of restructured our workforce. But you also had some periods just like Trump where it was under the average. But overall, under President Trump, we were averaging about 181,000 new jobs a month. The last 3-month average today is 185. So I always tell people it's about the same today as it was pre-COVID. Not endorsing one person or the other. That's just what the numbers say. Looking at the unemployment rate, you can see this orange line shows where we were at just when COVID was starting to hit versus now. It was slightly lower in February 2020. But overall, when you look at the averages between the two, 4.0 versus 4.1%. So almost the same. There's something that I think I need people to understand. We're dealing with a $30 trillion economy. Don't you think every president would want the unemployment rate to go down? Don't you think every president would want positive economic growth? They're desperately trying to buy your votes and keep the economy growing. But what they seem to forget, and we as voters obviously do not understand, not one president, not one Congress, and not one party can change the trajectory of our economy. It takes a lot to move $30 trillion in a different direction. It's nearly impossible for one president, one Congress, or one party to change it. Congress has 2 years, and then we do re-elections, and then usually it swings to the other side. And we have 2 years of compromise, and then we get a new president or we get the same president, and then they have 2 more years. And all these micro changes are not enough to change things because the goal is the same. People forget we are Americans. Most Americans, I believe, want the economy to grow. They want unemployment to be low. They want everybody to have higher levels of success. They are trying to change it, but not one president, not one Congress, and not one party can change the trajectory of our economy. They've tried. President Trump did what he thought was best. President Biden did what he thought was best. Unemployment rate's basically the same. The number of jobs right now are basically the same. Other indicators as we're going to look like, you're kind of being dishonest if you try to compare them because it's a different environment today than we saw in 2019 because of COVID. So speaking of consumer spending, you go back and you look at President Trump. He had some dips. This is a percentage change in spending. He had some slow times and some good times, and overall not a bad period. President Biden's rate of change of consumer spending was just spectacular. But if you look at where we're at now, kind of around some of the better periods of President Trump, the average under Biden has been much higher. But what's being missed there is it doesn't factor in how much money was sent to people twice under President Trump and then once under President Biden. We sent stimulus checks, and those stimulus checks got spent. Those stimulus checks got built up, and we shifted the way we spent money. We've had inflation. That's caused people to spend more money that maybe they didn't want to. We've squeezed down the savings rate. That's people spending money and not saving. This isn't a fair comparison, but what I want you to look at is overall, we're kind of about the same if you factor out the stimulus checks. And I'll talk about that later before we close things out. What I think is important, and this is not me, changing the data. No matter what the data says, people feel worse today than they did before President Trump left office. And that shows up in consumer sentiment. Is you can see we had a nice surge after 2011 under President Obama. People felt really good. And then during the election, consumer sentiment dropped. Just before the election, it started to pick up. And then you could see the fluctuations during COVID, that really plummeted things just from February 2020 to April. After President Trump left office, somewhere in here, we saw sentiment continue to go up. Ironically, when the last stimulus checks hit, that's when things plummeted, but that's also when inflation started picking up. So consumers are very upset about inflation, so they don't feel very good. And then you saw it steadily rise till March 2024, and then it's fallen again. So people in general don't feel very good about things. If you look at other surveys like the approval ratings, when President Trump left office, he had a low approval rating. President Biden has a low approval rating throughout. Congress has an all-time low approval rating. The Supreme Court has an all-time low approval rating. Americans just don't feel good right now. That's not because of one party. That's not because of one president. That's not because of one Congress. The data says Americans are unhappy with both parties. So you should not expect your favored party winning to completely change the direction of our country. It just doesn't work that way. There's 300 million plus American adults. They just aren't going to change because one person is in charge or one party takes over or one Congress takes over. It's too hard. It's too much built up to change. We all feel way worse than we did in 2000 at the turn of the century. But we feel better than we did in 08 and 2011. So not one person, not one party, not one Congress is going to change things. Looking at investments, I like to look at investments because that's how good do people feel about the future? Are we building things to help stimulate growth longer term? One of the best views on investments is building permits. There's so much economic activity that goes around a new house going up. But the other thing I've started watching is multifamily housing starts because we have such a gap demographically between younger people wanting to buy their first home and really big homes that older people have that cost a lot of money. And we have this disconnect where we need more multifamily houses to be going up. So what we're seeing now, again, this was not because of the presidents or any policies they had, but you saw a nice steady uptrend with Donald Trump and building permits. Can't argue with that. We saw the drop during COVID, but then we saw a really big increase shortly thereafter. And that's because, again, we locked up the economy. We sent people checks. They decided to move to bigger and better houses. And we saw a big surge. And then under President Biden, we've seen the number of permits drop quite a bit and then kind of flatline, and now they're going up. But overall, if you look at the numbers, you'd say, well, President Biden's been better for housing. Well, that's not fair. It's a different economy that we're facing. Not one president has changed housing policies enough to generate it. Giving people whatever Vice President Harris wants to do for new houses. The economic example I gave is if I give everybody $25,000 to buy a house, you know what's going to happen to the price of a house? It's going to go up by $25,000 magically. It's what happens with college. It's what happened with healthcare. It's what happened with anything where we give people free money to buy something is there's now more demand. It's more easily paid for, so the price just goes up. There's no policies that either one has proposed that says, let's build affordable housing for people just buying a new house. But I'm not president. I'm not running for Congress. But that's what needs to happen. There's not one policy I've seen proposed that's going to suddenly get us more affordable housing. The next slide, and I will tell you, honestly, I did not believe this number because as educated as I believe I am, with everything, I really believe that we were drilling more oil under President Trump, but the data says differently. If you look at the thousands of barrels per day that the US is producing, you can see under President Trump, we did see a nice increase during his presidency until 2020. And you're like, okay, so let's pause on that thought for now. But under President Biden, we've seen the number of barrels of oil increase every single year. Now, I asked people when I saw this, I said, do you think President Biden's policies are leading to more oil drilling? And people almost exclusively would say no. The issue is the free market still determines how much oil is drilled. President Biden, who wants the economy to grow, actually relaxed restrictions on drilling. President Biden released some strategic reserves to try to get oil prices to come down. The president, no matter the party, want the economy to grow. So they want to produce more oil to make it cheaper for gasoline. That's just it. But the free economy was growing so fast that we had to produce more oil, whether the president liked it or not. The same way, it wasn't a President Trump policy that caused this drop in oil. It was the fact that we shut down the economy and nobody could drive. So the free market said, we're going to produce less oil. That's it. That's all there is to it. Biden didn't do anything. Trump didn't do anything, but the numbers say Biden is producing more oil than Trump, but it's not their policy. They just happen to be president right now when the economy's growing, when we needed more oil. So we produced more oil as a free government. So looking to government indicators, another source of spending, as we talked about. I want to talk about interest rates real shortly. This is the change in federal funds rate. This is the rate that the Federal Reserve plays with. There's the cut they just implemented recently. A couple things I want to point out there is, first off, before the last 3 recessions, the Fed was already cutting rates, but we still went into a recession. So I think that's important. Also, you'll see a bit of a weird experience for President Trump in that rates were already going up a little bit before he became president. And then with the tax cuts, inflation started picking up. So the Fed started trying to tamp down inflation a little bit. But then ahead of COVID, they had to cut rates all the way down to 0. So overall, President Trump actually had lower interest rates than President Biden has had. But that's not political. And I think there was a question about that. I'm going to talk about that at the end. But overall, what you see happening is just because interest rates go down doesn't mean we avoid a recession. The other thing that, again, I had to check these numbers. If you look at this data, it would say that Republican presidents grow spending in the government more than Democrats do, because that's what it says. You look at both Reagan, both George Bush's and Trump, it's faster than Clinton, Obama, and Biden. Now, again, you can't say all of COVID spending needs to be credited to Trump. Just like you can't credit anything under COVID to either president. But if you look at pre-COVID President Trump, he still grew government spending at 5%. And we'll talk about this here in a second. That's because Republicans might not like wasteful spending, but they still spend a lot of money on defense. And because of increases we saw in defense spending, and I love the military more than most people, that is government spending as well. So you can't just think that because they're Republicans, we're going to see government spending drop, because the fact is every Republican president has increased spending at a rate faster than Democrats. So turning to our economic dashboard, and kind of looking at where we're at. This is something we put on the blog. We just put it on there last week. You can see our dashboard, every indicator other than stock prices is flat or down. And I did a whole article about that. I think it was last week or maybe 2 weeks ago, to talk about why that is, why that's a problem, and what it really means for the economic model. But for this presentation, what we're focused on is, where are we at versus 2019? Can we compare the presidents? And it's different. It's just a different environment because of this money supply, 216% higher. Congress, the president, and the Federal Reserve just threw a whole bunch of money on our COVID problem and our lockdown to try to fight things, and that just disrupted our economy. That caused consumer spending to jump by 135%. 135% of where we were. Stock prices are 79% higher than they were, and consumer goods orders, so durable goods, refrigerators, cars, things like that, 17% higher than we were in 2019. Flattish service businesses, jobs, hours worked, and building permits. Keep in mind, this is 5 years now. So we've only grown 5% in the service business over 5 years. So that's a very easy math, 1% per year, not very good. And then the bigger concern is we're still at 2019 capacity utilization. That's the percentage of our factories we're using. We're still running at 2019 levels. Obviously, it dipped and it's come back, but that's a problem. And then, as I mentioned already, consumer sentiment is just so pessimistic that things are not great, but they're also not really dire. It's just, it is what it is. It wasn't one president, it wasn't one Congress, it wasn't one party that caused this. That's just the economic environment and what it wanted to do because of the situation we were in. So inflation, obviously, that's a hot topic among most people. And a lot of people would blame Biden for the inflation. Again, I say it's not one president, not one Congress, and not one party. If you take a step back and look at the long-term averages, the blue line is where we're at today. We're basically back to the 10 and 20-year average of inflation. So yes, it's been uncomfortable. The 5-year average is ridiculously high, but we're basically at the long-term average rate of inflation. You look at it a little bit differently and look at the monthly inflation rate. The bottom of this red bar is the 2% annualized rate, and the top is 3%. You'll see times where under Trump, the monthly change was above 2 or even 3%. And so Trump left office right here. And his first month is, you can't blame Biden. The first, last month Trump was in office, in the first month or even these next few months, inflation was already going higher. The economy was moving inflation higher because of the stimulus checks being sent during the lockdown. It's now since dropped, not because of anything President Biden did. It wasn't caused by anything President Trump did by itself. Both sides, both political parties caused it. Both have now fought to get it down. We've run the last 4 months below 2%, which is positive. Hopefully that trend can continue. Let's go back to potential GDP. Revisit this equation. Again, I always ask, how many people are working? What are they producing? However, when you look at it and you look at what this should have been over time, you could see the solid line here versus the dashed line. You have no periods where the economy grew equal to or above potential. It's always been below. The other subcomponents of that, you could see productivity plus or minus a half or quarter of a percent has kind of been the same for a long period of time. You saw it declining during the 1990s, and then mid-90s it started to pick up a little bit, and it declined really since 2021, and now it's started to pick up a bit. The problem has been our labor force has been declining really since the early 90s, and it's flatlined. Demographically, if you look at things, we're almost through the surge of retirees, and we're going to continue to get a surge of millennials entering the workforce. So the labor force should start going up, which means productivity should start going up, which means GDP should start going up at a little bit faster rate, all things equal. The problem is all things have not been equal, because It's not just how many people are working or how much they are producing. It's where are we buying and selling our goods and services. We're running a trade deficit, which means exports are coming out. We're sending more money to buy stuff than we're receiving by selling our stuff. And the other thing is interest. Interest is simply future spending brought forward. And what that means is, and I use, my 17-year-old twins, the last of our 6 children, have bought cars. They're getting ready to figure out what to do about college as they graduate. And one of them likes to add things to his car, and he didn't have enough money saved up, and he asked me to borrow some money. And I said, that's fine. I'll do it. You can pay me back over the next several months. And I said, but you don't want to get into this habit. He learned the hard way, because now as he gets money coming in, he can't just look at his bank account balance and say, this is how much money I have to spend, because he's already spent some of that money and it comes to me every month. So he's paying me back. So debt is simply future spending brought forward. The interest on that debt is so unproductive, because that's money that's not even going towards the purchase of that. That's money going towards the financing of that. So it's not just how many people are working and how much are they producing. It's what is our trade deficit and what is our budget deficit. A couple of the things I look at when we look at debt, the dashed line is GDP. We hit a real turning point in 1984 when, as a country, we started to accumulate more debt than we had economic output. And then you go back to the financial crisis, and you can see we had another turning point where government debt just started going up at an exponential rate. That's this line here at the bottom. Household debt declined a little bit, and we saw, but it's all going up now. And you could look at 2018, and you could see it's just almost going parabolic now in terms of the level of debt in our country. That is not sustainable. That's all money we have to send back. Turning towards our trade deficit, the net exports is this line here. And you could see we're kind of the same as we were in the mid 2000s. We got the deficit closer a few times under President Obama to zero, but it's always been a deficit. You could see under President Trump, it improved slightly and it's deteriorated since then. We've done tariffs. We've tried to reshore jobs. We've tried to do things, but the problem is we're just not producing enough. Going back to oil. Yes, we're producing more oil. In fact, the US, volume wise, is the biggest single country producer of oil. Dollar wise, value wise, we're not. And what happens in our country is American made machinery and the things we buy in the US require a higher quality gasoline and oil to run. And our oil is not a high enough quality where it's very expensive to refine. So we produce a bunch of oil here, we sell it to South America and parts of Asia and Europe, and then we buy the much more expensive, more pure oil from the Middle East. So our dollar trade deficit is bigger, even though our volume is better. We produce more oil than we import, but the dollar difference is big. And so we continue to run a trade deficit. Just producing more oil here isn't going to work. We have to produce materials here. That becomes expensive and that becomes inflationary. So overall, you can see net exports are subtracting from our potential GDP about 5% per year. Turning to who's responsible, we all love to point fingers. This pie chart makes it pretty easy. We've accumulated the most debt when Congress and the White House has been split between the two parties. When the Democrats have had full control of things, they've added $7 trillion of debt by themselves. When Republicans have had full control, they've added $3 trillion. But the biggest culprit is when we have a split government. As I like to say, compromise might mean coming together with the other side to find a mutual agreement. But another definition of compromise, if you think about it, is to put yourself in peril. You're compromising your position. And that's what we're doing as a country, is we're compromising our position because of the way we look at things. So one talking point that I continue to see is, well, we just need to stop wasteful spending. The problem is that's not what's causing our deficit. If you look at just how much income taxes we're pulling in and what those income taxes are paying for, we're running a very, very, very small deficit. I mean, if you had asked me 10 years ago if I would be excited that our deficit was $113 billion, I would say that's impossible. This is one of the smallest we've seen since Bill Clinton. And that's not an endorsement of President Biden. We've had some very nice economic growth coming out of COVID, not because of one president, not because of one Congress, not because of one party. We've just had it because that's what the economy was wanting to do. But what you've seen happening since then is even we're running a basically a balanced budget for income taxes, but Social Security and Medicare, the so-called entitlements, are the ones running a deficit. And so a lot of you might say, hey, we have this trust fund. I used to think that we had a trust fund. So all the money that comes out of my paycheck that my employer pays in on my behalf, it goes in this little holding account, the Social Security Trust Fund. And then when I'm ready to take it, there's an account with my name on it, and I get my money back. Theoretically, that's how we were told Social Security and Medicare worked. The problem is, back in the late 70s, Congress was saying, wow, we're running really big deficits and we're having to borrow a lot of money at very high interest rates. What if we tapped into this trust fund and used that to fund our deficits rather than borrowing money from somebody else? We just pay this back with a very micro amount of interest. And we're being fiscally responsible, right? No, that's a great idea. So every Congress since then has been dipping into the trust fund, saying, hey, trust fund, I owe you $14 billion. That covers my pet project. I owe you $100 billion. There you go. So now when the FICA tax receipts are not enough to cover Social Security and Medicare, we have to go out and borrow the shortfall because we go to the trust fund and the funds aren't there to cover that. So we have to then go and borrow it, and it comes out of our budget. So our budget is not wasteful spending. The reason we run a deficit, it comes down to Social Security and Medicare. All of the tax receipts, including FICA and Medicare, are only enough to cover Medicare, Medicaid, Social Security, defense, and VA benefits. That's it. We could wipe out transportation, education, other spending, which is all these categories here. Welfare is a very popular, thing to bat around and say, well, we're giving people too much free money. I probably mostly agree. I think there are some people that need it and we need to take care of them, but we probably are spending too much money on welfare. But let's just say we did zero welfare. Guess what? We still have to borrow money. What if we just wiped out the Department of Education and Transportation? Forget it. Let's wipe out federal police, fire, courts, prisons, the legislative branches, the Department of Research, Economic Development, Agriculture, Energy, Environmental, DEA. Let's get rid of DEA. Yeah. Let's get rid of all of them. Still run a deficit because debt is future spending brought forward. And last year we had to borrow $700 billion just to pay interest back. $700 billion was borrowed to pay interest on things that we've bought since the late 1970s. You cannot balance this. You cannot fix our debt problem by cutting wasteful spending, by ending welfare. By the way, you couldn't tax people enough to cover this. Some of the tax proposals I've seen coming out of the left might add $1 billion or $2 to $1 trillion deficit. Think about that, $1.7 trillion in deficit. And again, it's not wasteful spending. It's these entitlement programs that we borrowed from since the 70s. Not one president, not one Congress, not one party. Both parties are responsible. So both parties should fix it, but they're not. Because guess what happens? If I dare say I'm Jeff Hybeck and I'm running for Congress and I'm going to fix the deficit in Social Security and Medicare, I will not win. I will not even get support from the Republican or Democratic Party to win a primary because nobody understands how this works. Nobody seems to be thinking about by 2032 or 2033, when there is not enough money left and all it is borrowing, we have to reset benefits by 80% or figure out a way to raise it revenue to balance it back out. I, as candidate, want to fix it now with some common sense things. But if I do that, the AARP legislative lobbying group on both the left and the right is going to come after me to the point of I will not get support even in a primary election. Likewise, I don't care which party I'm from. If I say I want to slash defense spending, I'm not winning. These are the untouchables. Politically, people have learned you do not mention Social Security or Medicare reforms or defense cuts because you're not going to win. So guess what happens? We keep growing the deficit. We keep adding to our interest expense, where it does not matter what transportation, education, other spending, and welfare is. You could slash all of them to zero, and we're still going to need to borrow money at higher and higher interest rates because we as an electorate are too naive to do our own research. Both parties are responsible for this. They have been since the 70s. We as voters, my first time to vote was 1992. Ross Perot told us about this. We thought that crazy old man doesn't know what he's talking about. He's the last legitimate candidate to get any votes who dared mention Social Security and Medicare reforms. Now it's popular to say, I'm going to give Medicare for all. We're going to expand benefits. Heck yeah, I will buy your vote. Because that's what they're doing. They're trying to buy votes by refusing to talk about this or by offering even more benefits. That's just what it is. It's sad, but that's what it is. Looking at it on a budget line basis, here you go. The 2025 estimated spending, you could see everybody says, oh, let's cut welfare, other spending, education, transportation. We can't. Now look at interest expense. Almost $1 trillion by 2025 will be going to other people who loaned us money to support our spending since the 1980s. We borrowed and borrowed and borrowed and borrowed and borrowed. We made promises in Social Security and Medicare we just simply could not keep. And now we're paying $1 trillion a year in interest. It's almost, if you ignore VA benefits, we're going to be spending more on interest expense than we are on the military outside of VA benefits. And I'm not saying touch VA benefits. Those people, they deserve probably more than they're getting based on what we put them through. But just military spending, current defense, interest is going to be more than we're spending on defense. You want to talk about making us weaker? When you owe money to other people to support your standard of living, that's when you're weak. Neither party dares talk about this. So I'm going to take a deep breath because I need to move on. We're running out of time and I got a few more things to talk about. Turning back to the stock market, because that's what we talked about. How does this impact your investment? If you look at just the presidents and the numbers, I think this is a very unfair comparison, but you would say all-time best performance for any one president was Bill Clinton, followed closely by President Trump. President Trump loves that number because I talked about this a lot in 2018 and 2019. He seemed to adjust his policies based on how the Dow Jones numbers reacted that day or that week or that month. but very nice performance. But a keen eye will notice Obama, also a Democrat, and Biden also had better performance than George W. Bush. Well, poor old George W. Bush, stepped in at the end of the tech bubble, enjoyed the housing bubble, only for that to burst under his watch. So in 8 years, George W. Bush saw both the tech bubble and the housing bubble burst. That was not one party's fault. That was not one president's fault. That was not one Congress's fault. That's just what happened. The stock market and our US economy is bigger than any one president. It's bigger than any one Congress. It's bigger than any one party. They might be able to tweak things at the fringes, but their success is going to be based on where we're at in the cycle and which way the free market wants to go and is ready to go to. And it was ready to burst under George Bush. Then we had the housing bubble and it burst again. So that's why it was negative. If you zoom out and say, let's go all the way back to the post-Depression, overall, if Republicans run the show and Democrats run the show, it's about a wash. What Wall Street really loves, it seems, is a divided presidency and Congress. And that's because they can't do anything. And we're going to talk about that when we close things out. It takes a lot to change economic policy. So if everything's divided, we're going to have that compromise word, which, as we learned, is what's leading to the most debt, because we're always compromising. So a couple of other things. Long term, because I know a lot of people are focusing short term. Long term, going back to potential GDP, how many people are working? How much are they producing? If our working age population continues to grow, which it sounds like based on demographic data, at least until 2080s, so most of us will not be alive then, the working age population should continue to grow. I'm going to assume they continue producing things at the same rate we've enjoyed the last 40 years. So potential GDP should be up. I'm going to also assume that we figure out our debt problems. So over the long term, the math says the stock market's going to be higher. So if you could buy today and not sell till 2080, I'm pretty confident your investments are going to be higher. But over the short term, what happens is our human emotions cause us to get overly optimistic and overly pessimistic, to the point of the economy gets to the place, or the market gets to the place that the economy can't support. It rolls over and it drops, and then it starts to get too pessimistic, and then we start to have growth. It goes through these cycles again and again and again and again. That's what we're trying to do at SEM. So long term, and I would say longer than 15, 20 years, if you don't look at your values from point A to point B, you'll have a nice steady uptrend. If you focus on those values over every week, month, or even year, you're going to see some fluctuations. The problem is we're buying at high valuations historically. We're buying high, hoping to sell higher, which typically is a bad thing to do. If you look at the long term, going back to 1926, stocks have given us about 10% annually, bonds about 5.5%. However, based on current valuations, the biggest names in investing are saying we better expect lower 10-year returns. 6.1% from BlackRock, bonds 3.9%. Vanguard is actually looking at returns of 4% for stocks over the next 10 years and 5% for bonds. So they're saying bonds are a better investment over the next 10 years. And then Morningstar, as of the beginning of the year, was saying 4.6% for stocks and about the same for bonds. So the biggest names in investing are saying you should expect lower returns over the next 10 years. Now, they're not saying over the long term. Long term will revert back to 10%. But what they're highlighting is this cycle that we go through of overly optimistic, like the tech bubble, where we got 15.9% returns. Then we got overly pessimistic and we returned back to the mean, only to get overly optimistic again, overly pessimistic. This bubble we've had, I call it the everything bubble. We had a slight 22% correction in 2022, and now everything's going up again. Cycles tend to repeat. This is just going back to the 90s, but we see this repeat going back to 1926. We get overly optimistic, followed by overly pessimistic. So Vanguard and BlackRock and Morningstar isn't saying expect 5% steady returns over the next 10 years. I would love that. Sign me up for that. Promise me 5% straight line, no volatility. I'll take it. Yes, it's half of the long term, but I'll take 5. It's not guaranteed, though. What typically happens, to get to 5, you lose 50, and then you spend the next 7, 8, 9 years to making it up. And that's what we see happening. That's what I'm worried about. The other thing I want to focus on is what we see in the election is whichever party wins, they say, the voters have spoken. We now have a mandate to do whatever we want. Even though the results are usually 51% or less of the voters voted for that person and that party, I don't understand them ruling from the far right or the far left. But that's what we saw happening. In 2016, Republicans won the White House and Congress for 2 years. They said, here is our far right agenda, and we're going to go for it. And all that did was offend everybody left in the middle. Because according to Gallup, the number of Republicans and Democrats, Republicans have kind of been the same really for, almost since 2008. Democrats have been steadily declining overall since 2012. The independent voters are the ones calling the shots. So what happened in 2016 was enough independents who had supported Obama swung over to support Trump over Hillary Clinton. So the independents gave Trump the election, and then he ruled with Congress for 2 years with the mandate that we can do everything we want from the far right. Almost the exact same percentage of independents who had swung from Obama to Trump, swung from Trump to Biden. Biden wins with a very, very tiny majority. He wins Congress. Then Biden says, guess what, guys? I have a far left mandate. I'm going to go and lead there. So then the independents say, whoa, 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 buddy. We're going to give Congress back to Republicans then. I don't understand these candidates who win by catering to independents, because you cannot win the election by just winning all the Democrats or all the Republicans. Less than 1/3 identify with one or the other parties. 1/3 of the country. That means 2/3 of the country is like, I don't really support your far left or your far right agenda. Yet we see over and over again Congress trying to lead that way. So what we need to understand is day one, we're not going to see major changes. We will see a ton of executive orders. We saw it the last 2 inauguration days. Anymore, the Supreme Court's coming back and saying, hey, buddy, that's illegal. You cannot do that. Or they put an injunction on, or they drain it, or they say we need to review it. Major policies cannot change. The direction of the Department of Justice or the direction of the Department of Labor or Homeland Security, that can be tweaked. But then there might be some group that comes in and says, well, we're suing to put an injunction in. Nothing major can happen with an executive order. Number 2, and this is important, talking points are not always the priorities once they win. About 1/3 of voters on each side have already made up their mind, probably more than that by now. So we're seeing like crazy, what if we did this? Oh, cool. My poll numbers went up by 0.1%. Well, what if I did this? Oh, my poll numbers went up. They're just throwing out these wild things. 200% tariffs on John Deere tractors. Unrealized, gain tax on people. They're just throwing out things that will probably never become policy to try to buy enough votes to win that 50.1% of the electoral votes they need. That's all they are doing. Please ignore the talking points, especially these ones we've seen pop up in September and the beginning of October. Please, those are not going to be policies. Because you cannot pass economic policies without both sides. Budget legislation starts in the House, has to be approved by the Senate. Sometimes the Senate will try to start it and get it approved by the House. Both sides have to agree, and then the president has to sign it. Even if both sides, say the Democrats control everything, there's enough fringe Democrats, because they're getting voted on again in 2 years, who are not going to vote for everything that the Democrats want. So even if one side controls everything, it takes all of the, a majority of the House, a majority of the Senate, and the president to all agree. We're just not going to see all these fringe talking points become economic policy. The other thing to understand, the stock market is forward looking. And the reason it is they're anticipating what's going to happen. Because what happens is everybody in Washington has contacts on Wall Street. So if I'm a level member of Congress and I'm trying to decide what to do on a law that I heard about in committee, I'm going to call my contact. I should say my staff's going to call my contact, and they're going to say, hey, what would you think of cutting the capital gains rate to 10%? Or what do you think would happen if we raise the capital gains rate to 33%? They're going to tell me. But then if my neighbor in Congress calls and says the same thing, and 12 other members of Congress call and they all say the same thing, Wall Street's going to go, this seems to be something that's going to happen. So let's start calling our clients and say, hey, we think capital gains are going down, or we think capital gains are going up. Let's start getting to work now. That's not insider trading. That's a mosaic approach to investment analysis. There's nothing illegal about that. I don't like it because we're not a big Wall Street firm and we don't get tips, but we talk to people on Wall Street. I put it in my blog when I talk to them. We're all going to know ahead of time before something happens. Look at 2017. The Trump tax cuts did not become law until 2018. Yet the stock market did significantly better in 2017 ahead of that, because everybody on Wall Street was saying these are going to get passed by stocks. They got passed, and then the market had two big drops to finish the year kind of flat in 2018, the first year of the tax cuts. It just happens that they're going to anticipate it, so there's 0 point in implementing your policies now. The other thing, in my career going back into the mid-1990s, I've never seen a tax increase be retroactively applied. In other words, let's say January 25th, Congress does a record-breaking agenda. They pass tax hikes on people over $100,000 in income. They will not say this is retroactive to January 1st, 2025. They will say it starts in 2026, or it's phased in over 3 years starting in 2026, or this one doesn't go in until 2027. The only thing I've ever seen retroactively applied is a tax cut. And even then, what was that, George Bush, 2002? It doesn't happen. They have to have time to get ready for it, which means if capital gains rates are going up, if income tax brackets are going up, if tax write-offs are changing, we're going to have time in 2025 to adjust. So don't take something that's going to happen because of a talking point and assume you need to act. Just not going to happen. So keep that in mind. And then finally, what matters more is Congress. Wall Street prefers a split. We'll probably see a bigger rally if we have a Republican or Democrat in the White House and the opposite controlling Congress. All right, and finally, we've done a lot of work on this on our website about behavioral finance. We've talked about this since 2016. What I do want to remind people of is we have such complex brains that when we go to make decisions, that sometimes they can be the wrong decisions because it's very hard to it's very hard to process a bunch of unknown things. Um, so definitely check out those resources on us, but keep in mind our brains are tricking us. It's not a bad thing. That's just what makes us humans. I also like to remind people of, as I mentioned with some of the tax law changes, the key to understanding things in every decision that we make comes down to your financial plan. So there will definitely be things that change based on who wins the election on your financial plan. But as I mentioned, you're going to have time to do that. We should not change your investments anticipating what the impact of those changes are going to be. Again, not one Congress, not one president, not one party can change the direction of the economy in just a few policies or just a few years, even. But there will be things that change, and your financial advisor will need to be able to change them, and then that might change your investment selection. At SEM, what we focus on, this is a list of all of our different models we have out there, from short term to long term, strategic, dynamic, and tactical. We can make quick changes if need be, or there's going to be things that our data just says, it's not important. How you're allocated is based on your financial plan and your cash flow strategy. So keep that in mind. We always update this chart on our blog every week if you want to keep following along. And then how to get more information, semwealth.com. Always tell people, if you're a client of ours, take that risk questionnaire. If you're uncertain about what's happening, we can do a quick portfolio review based on that. The blog, you go to SEM Market Insights there at the bottom of the page, and you can click on the link there to see the latest updates from us. We also have some fun personal finance stuff on TikTok and Instagram. We will share those on our Facebook and Instagram or LinkedIn pages as well. And then one of the new things that we started doing just maybe a month or two ago is Money Talks with Dad with my oldest daughter, Corinne. We sat there and we just talk. It's like conversations we've had, over and over, of things to help people with their finances. We did one on politics. I think it's probably worth tuning in. We've posted 3 episodes now, so you can follow us on YouTube there. As she does not like me to say, make sure you smash that like button and ring the bell so you get notifications. But I heard it on YouTube 10 years ago, so I'll keep saying it. So that's there. So next, we want to start with questions. People already sent in some questions with their registration. If you want to pop into the queue, there's a button there for Q&A that you can grab. And I'll just go ahead while I accumulate those questions. We will answer some of the ones that came in ahead of time. First one from Mark. The biggest difference I see in the candidates is the tax consequences for investors and businesses. Can you address this, please? We have a lot of policies proposed. And yes, it sounds like in general, one might be better for taxes, one might be worse. Again, like I said, they're just trying to buy votes at this point. So we don't know what's going to actually be implemented with Congress. We have a little bit more concrete things with Donald Trump. Overall, he's expected to cut taxes based on the Tax Foundation and nonprofits research and analysis. Gross tax cuts of overall 8.5 billion trillion, billion dollars, but also going to, with tariffs, increase some tax revenue in theory. When we turn to Kamala Harris, there's a lot of things she said. Nobody can really figure it out. No concrete policies. A lot of the things have to go based on what Biden did, because a lot of her policies are saying, I agree with what Joe put out there. So we kind of have that to go on. Overall, the Tax Foundation analyzed some of those. I don't know how much I take with that, because then I saw something from the Congressional Budget Office that said Trump's actually going to add 7.5 trillion in debt, and Harris would only add 3.5 trillion only. When you factor in spending plans, what does the economy? Nobody knows. The other thing to talk about, talking points, is they looked at Trumponomics and said, well, if Donald Trump actually got everything put in, understanding economic theory, if you cut immigration and there's not people in the US that want to do those jobs, you're either going to lower production, you're going to have fewer people working, or it's going to cost more. So, as we talked about with potential GDP, that's going to cause the economy to go backwards. If you have put in tariffs, that's inflationary. If you have to pay people higher wages because you can't have low cost immigrant labor, that's going to cost more. If you make things in the US versus overseas, that's going to cost more. So, what this institute is saying is Trump's rhetoric would actually lower GDP growth and increase inflation and lead the Federal Reserve to have to raise interest rates. Now, what they're saying, if you read their whole analysis, is there's no way he'll implement all this rhetoric, mainly because he understands a lot of it is going to be damaging. He wants to make the economy better. He wants the stock market to grow. Again, both presidents probably want that to happen, I would hope. But the rhetoric by itself is a negative. Not saying good or bad. I'm just saying he's the only one we actually have policies on to evaluate. What I'm seeing personally from both sides is we're due for a recession. And because they're trying to attract the middle class, and because the economy has gotten so imbalanced since the pandemic that the things they do will hurt the upper part of our economy enough to slow things down. Even though longer term it might be good for the middle class, we're due for a recession. People got too much money. We gave them too much. There's too much money floating around. Recession wrings them out. Both their policies are likely to cause a recession, not by themselves, but just because the economy is due for a recession. So I know that didn't answer the question. The other thing I'd really like to point people to is we've seen this going back to 1990, tax cuts, tax increases. Here's consumer spending. You can't even see a blip when Clinton raised taxes. Kind of you saw the consumer spending accelerate a bit when he implemented some small business tax cuts in 98. And again, I say it was Congress who voted on them and Clinton signed them. So the person signing them gets credit regardless of party. So technically they were Republican passed tax cuts, but Clinton liked them enough to sign them into law. Then the expiration of the Bush tax cuts didn't even cause anything. Like spending was actually still strong even after those tax cuts expired. The Trump tax cuts, spending started going up before then. It was on a nice, slightly higher trajectory. And then the pandemic hit, and you could see what COVID did. So it wasn't tax cuts that caused consumer spending to go crazy. It was the fact that Congress sent everybody so much money. And again, two of those happened under Trump, one happened under Biden. We're so far above the trend right now. That's too much excess. We're due to wring some of that out and get back down to the trend. I don't know how we do it without causing a recession. So that's that. Next question was from Steve F. Why are mortgage rates going up even though the Fed cut rates? And then there was another question that I kind of grouped together of it seems fishy the Fed would cut rates so much just before the election. Thoughts? I'll go backwards. I don't think the Fed has any sort of political agenda. I think they saw the labor market slowing down and inflation getting close to their comfort level and their target, and they said we better cut rates now. I said at the time, I think there must be data that they see that's scaring them. Maybe some banks are running into problems. I've never seen the Fed act politically. There's been pressure, from, I don't remember Obama putting too much pressure, some rhetoric. Trump, definitely, he was, anti-interest rate cuts when Obama was president. And then when he was president, he was anti-rate hikes. He wanted rate cuts. And now he's critical of the Fed again. I mean, presidents want the economy to go up. They want jobs to be produced. They want inflation low. The Federal Reserve is still independent. I don't think there's anything to that. What I think you need to understand with mortgage rates versus the Federal Reserve is the Federal Reserve only controls short-term rates. Mortgages are based on long-term interest rates, which the free market sets. Again, like we said before, the market's a forward-looking mechanism. So this blue line is the trend and the level of 10-year rates, which is what mortgages tend to be priced on. And the red line is short-term rates, which is what the Federal Reserve controls. And you can see their rate cut there. In almost a year, we saw interest rates drop on the long-term side by 1%. Now, this chart was only through the end of September. We've seen these rates now get back up over 4%. So from a year ago, rates are about 0.9% lower on the long term. So mortgages came down over the last year about 1%. The latest weekly data shows them going back up because the bond market, the free market, not the Fed, is saying this might be inflationary. Therefore, interest rates on the long term should go up. So mortgage rates have been going up. And that's something when the Fed cut rates that I mentioned in the blog was you can't be guaranteed that cutting rates is a good idea. Because if it causes inflation, that's bad. And if it doesn't help the economy, like we showed in the other slide earlier, that's also bad. So mortgages are not moving right now because the free market is saying interest rates might need to go higher because of inflation, no matter what the Fed does. The other thing to keep in mind, this is a yield curve that I put in the blog almost every week, the difference between short-term rates and long-term rates. You should get more interest for longer term because you're taking on more risk. There's more uncertainty. So normally you see long-term rates higher than short-term rates. The green is what we had 10 years ago. This X is what we had 3 and 5 years ago. You could see 3 years ago, we were already starting to see a weird environment. But this is what you expect normally. They call it an upward sloping yield curve. Where we're at today versus where we were at a year ago and a month ago is not normal. We need to see these short-term rates come down or this long-term rate go up to be more normal. So the free market has said this is where long-term rates should be. The Fed needs to push these down. So unless we're going to see the Fed doing other things to push interest rates down longer term, we may not see mortgages drop that much more in rates. And in fact, they probably won't drop unless we have an economic slowdown. So hopefully that answered those two questions. Another pre-prepared question that came in with the registrations from Cody said, would you expect the trend of strong post-presidential election years to continue? And he referenced 09, 13, 17, and 21, which were all definitely very strong timeframes. Again, the economy is due for a recession, regardless of who's president or who controls Congress. The economy or the market's overvalued, as we showed with the 10-year returns. But the trend is up. Maybe we remove uncertainty. So there can be a case for a good uptrend. Ignoring just the last 4 elections, I went ahead and grabbed this data from Fidelity and looked at things that said, first of all, post-election, so from November 30th of the election year to 1 year later, the median or average return is 8.3. We've seen big returns over 30%. We've also seen a drop the first year. So we shouldn't assume it's always going to be up. And then the pre-midterm, so second year, midterm elections, post. And then you could see the election year is usually the most volatile. The data says maybe a coin flip. So it's going to be up to the trend. So sorry, Cody, to not give a stock market prognosis on that. The data is just too big of a range, but you can see what typically happens is a range of -20 to +30, with an average of 8%, slightly below the long-term average. Probably going to have to do with what's in Congress. So that's all the pre-prepared ones. Let's see what we got in the Q&A chat. The first one, anonymous. Well done. I wish everybody would see the data this way. I promise to not pay this person. I appreciate the comments, though. I'm not going to read the whole thing, but thank you. The goal of this is to provide data. The goal of this is to let you think for yourself and become better educated, and that's all. That's all I care about. Next question. Let's say, okay, can the president do anything to lower gas prices short term? Parentheses, asking for a friend. They can try, but it's really up to the economy. If the economy is growing and people are driving more, and that creates more demand than we have supply, prices will go up. Well, we saw during COVID, we had so much supply and nobody could drive. So the last part of President Trump's presidency, we saw prices plummet. And then when we started opening up the economy, we had a shortage of gasoline because producers had cut their gasoline and people started driving, so prices went up. It's just trying to find an equilibrium. They can try to manipulate it, but not one president, not one party, not one stroke of the pen, not one Congress can change the trend in gasoline prices. They can try things. I think it was George W. Bush tried to temporarily eliminate the federal gas tax. That's several, 20, 30, 40 cents in the gallon, I believe. So yeah, they could do that, but that's just a short-term blip. So I guess the answer is no. I don't believe they can do anything that's sustainable. Again, they want lower gas prices. They want more jobs. They want a stronger economy. They want lower inflation. If they could do it, they would. If they could just snap their fingers, they would. I don't see, others are just comments. I appreciate the kind words. So yeah, I don't see any other questions. So we'll go ahead and end it there. We'll try to get this replay up for everybody. Stay tuned to the blog. Keep asking us questions via the blog, via our website, and stay tuned for our post-election analysis when we can start talking about some of those policies that may become law. So thank you.